Paul here from My Perfect Failure, helping you turn your failures into successes and your setbacks into opportunities. What if your relationship with money could be as peaceful and as intentional as meditation? Today I'm joined by Mick Heyman, a seasoned financial wealth authority and advisor, and also the author of Mellow Your Money, who's made it his mission to help people see wealth, work, and spirituality as a connected journey. In this episode, Mick shares how embracing failures shapes resilience, why our emotional mindset is the key to investment success, and how difficult mentors can teach us life's most valuable lessons. We also dive deep into the psychology of wealth and how managing money can actually make us better human beings. So this conversation completely reframed how I think about money and mindset. It's one of those episodes that stays with you long after it ends. So if you're ready to mellow your money and your mindset, hit play and enjoy this eye-opening chat with Mick Heyman.
Who knows what Jay-Z, J.K. Rowling, Bill Gates and Oprah Winfrey all have in common? Okay, I will tell you then. They have all overcome failure in one shape or form to go on to gain success in their respective careers. Welcome to My Perfect Failure. Join us as we delve into the world of our perfect failures. We will interview, explore and discuss how our perfect failures can lead us to success. Join us and tune in.
Welcome everybody to another episode of My Perfect Failure. Today, I'm super excited as I have another amazing guest for you. So today, I'm joined by the founder of Heyman Investment Consulting. With over 40 years in wealth management, he has developed a unique stress-free approach to help people and institutions build and preserve wealth. He holds a bachelor's degree in economics from Northwestern and is a Chartered Financial Analyst, but it's his interest in philosophy and psychology that has shaped his investment approach, focusing on human behaviour as a driver of markets. He has featured in the Wall Street Journal and other financial publications and writes regularly about mellowing your money on LinkedIn. Outside of work, he enjoys tennis, golf, surfing with his kids, and practices meditation and yoga. So a very warm welcome to My Perfect Failure, Mick Heyman. How are you, Nick? Mick, sorry.
I'm doing great, Paul, and thank you. I'm excited to be on the podcast. I really appreciate the opportunity.
No, it's a pleasure. I love your bio. It just got a perfect blend. So you've got the finance covered. That's just not finance. You've got finance with psychology, philosophy, and so obviously we all want to be on top of our finances. But if we can have that cohesion where we're sort of de-stressing finance, I love that. But then you cascade into tennis, golf, surfing, kids. No, that sounds pretty good to me.
And it all, what I've learned over time is it's all interrelated. So often we want to separate, parts of our life. There's this basket of, this is the money part, this is the spiritual part, this is the works part. And one thing I've learned is there's really no parts. there's just this one glob of things, and it's all interrelated. I've learned fascinating lessons from the markets and the finance that have taught me about my life, and vice versa. Things have happened in my life that interrelate, and so it is all of a basket of who we are.
Is that part of the essence of where you see people maybe having that disconnect and going wrong, where it isn't connected? It's all sort of these disparate parts, and it's all difficult to maybe bring the puzzle or pieces of the puzzle together.
I think that's right. I think so often people, want to separate aspects of their life, and they don't see it as interrelated. And it comes back to being able to self-reflect and and see where you can learn your lessons, and when things go wrong, that's the, your podcast really hits on it for me. It hits home because it's our failures that teach us lessons. And in my life, at least, or I should use an example, when young kids or young people would tell me about their success in the markets. Oh my gosh, I did this. I bought Bitcoin. I did, something fantastic. I think, oh no, what a terrible thing to start off with. I, on the other hand, didn't have those successes right off, and it taught me humility.
Yeah.
And what a great lesson that is. So I'm not saying root against yourself, but be careful when it's success, because I don't think that teaches you the same as our misadventures.
Yeah. Yeah. I love that sort of appraisal, because success is really interesting, because everybody wants success, but sometimes success can really doesn't help with, not with everybody, but certainly with a proportion of us. Humility suffers. Maybe we think that we don't learn as much when we're successful. And I think that when we have difficult moments, I think it really balances us, and I think it makes us think. We develop resilience, and I think we just become better, become more improved. I think if we are around the right people, then also that we choose to learn, and we learn how to learn from difficult moments, because sometimes it isn't that easy, because maybe we haven't been around a mentor, or maybe a parent or an uncle or a teacher that's been able to give us some guidance in the financial markets, or in some other area of our life.
I agree. And I have been so thankful that when I look back, it has been those mentors and people in my life that have taught me lessons. But the other thing that brings to mind is that, of course, the mentors are so helpful, and I've been guided so wonderfully. But one of my great mentors always pointed out to me that sometimes it's those uncomfortable people, the people you would never call a mentor. They were a bad boss, or they were a bad teacher, or a bad circumstance. They too can be our mentors, if we look at it that way. But it's taken me a long time to get there. And I still am not 100% there, by the way.
Yeah. Well, that's a really good advice for me, and for hopefully anybody listening now. If we're going through a difficult moment with a boss, or somebody just doesn't get it, or doesn't get us, in our opinion, there's a learning opportunity there. There's something there. There's always something there. And we just have to be, I guess, open enough to kind of think, okay, let's take a moment here. Let's work out what's going on. So I got an email earlier on today, and it was something where it was probably more problematic than I wanted. So my first instincts were to kind of like respond. I'm going to respond to the email. And then I thought, okay, maybe not. Let's not respond now. And now I'm sort of in a far better place in terms of the best approach to respond to that email. I'm plagiarizing a little bit, but I've got a far mellower disposition in terms of how to respond to the email. I feel a lot better for that, because I can respond with more clarity, with not being confrontational. And that's what it needs. It doesn't need sort of a reactive moment. So I do think we can learn a lot from difficult moments.
No question. In fact, I think back to my first job, my first week that I was at that job, and my boss had asked me to write some little blurbs about some stocks we had bought, and I write them, and I go in there, and he always had this habit of these long pauses. And so he takes this long pause and he goes, "Do you think our clients are idiots?" And he, rips the papers up and throws them in the trash can. And I am just terrified. Like, oh my gosh, I'm going for the next job. And in hindsight, they were very poorly written. I think I've written that AT&T was the largest phone company in America. And he responded, "What idiot doesn't know that?" Back in 1980. It was the only phone company, by the way. But the lesson I learned through working with him was that I needed practice working with a very aggressive person. And eventually I could stand up to him. And that was something I needed in my early 20s. And it took a lot of practice. And eventually I had to rationalize, I may lose this job, but I need to take a stand. And so it is those uncomfortable circumstances that I believe really can move us to the next step.
Yeah. Okay. So excited to have this conversation with you today and obviously meet you. What I was keen to, I'm keen to discuss your book, but also I'm keen to understand where it all started. So what drew you into finance? What was there a moment or situation that drew you into finance?
I think there were a couple, but first of all, it wasn't like a dream, whereas today people grow up dreaming about, oh, I want to be a stock person or I want to be in the investments. Back when I was growing up, actually stocks were pretty bad. It was the 70s and it was real estate and oil and gold were booming. And when I told people I had gotten this internship at this investment counseling firm, people looked at me like, why would you do that?
Really?
And it was not an exciting place to be as far as a job. But what I loved about the business at first were two things. One is I learned that it was a way of helping people. We weren't just managing their money. We were helping them in their lives and helping them, retire or helping them, through, grow their livelihood. And so the clients I met early on were fascinating and fun, and I loved that part of it. And then the second part, of course, was the sex appeal of the markets. It was, back then there was this great show, Wall Street Week, with Louis Rukeyser, and of course, my dream was to either be on that show or like, you had talked about some friends who were trading and, trade on the Chicago Board of Trade and be this great hero. And I have to say that the trading part, that's another host of stories of failures. What I learned over time is I do not have the psychology to trade. It wasn't my path. And it took a lot of failed trades to kind of figure that out, that my path was long-term investing. My path was building wealth over time. And that I do believe that there are people who are situated to be good traders. And I actually took a lot of lessons in it and I understand it, but my psychology isn't there. And so that was another thing that caught me. But over time, I realized I was good at building wealth over the long term. That was, and there I could blend my interest in philosophy and psychology and working with people and blending all this that eventually I kind of stumbled into what I thought was the best part of investing over the long term.
That's fascinating. So is there a different type of psychology required for short-term investment and long-term investment?
What I've discovered with the way I was taught, I'd gone to a seminar and we actually were talking to the, I think he was the top trader on the Chicago Board of Trade that year. And he was saying, I'm going to tell you exactly what I do when I trade. And I'm going to give you the exact system. And by the way, I guarantee you, if you come back in a year, none of you will have used it. And of course, we're sitting there going like, no, challenge accepted. I could have used this thing. And it was pretty simple. What he said was basically there are four things that happen when you trade something. It can either go up a lot, down a lot, up a little, down a little. Four things. What he does is eliminate the downside. Whenever it goes down a little bit, he takes the loss. So it never goes down a lot. So all he has are a lot of little losses, a lot of little gains, and some extraordinarily big gains. Well, that makes intuitive sense, doesn't it? But the problem is he had to sell about 90% of his little losses to eventually get that 10% that were either little gains or big gains. Well, that's the trick, and that's the psychology. How many of us can stand lose, lose, lose. Eventually we say, I don't know about this one. This will probably work out. Bang, you get nailed. And so what I realized, and what almost everybody in that class probably realized over that year, is you have to be disciplined to the max to be a great trader. You have to be willing to take loss after loss, little ones, to get those big ones. And of course, I'm sure today there's plenty of other ways to trade, but either way, I believe it's the psychology of that trading that is so important. And I wasn't there. That's not me. I believe it's for people who trade a little bit, maybe they get lucky for a while, but eventually, if they haven't mastered the psychology of it, they're going to lose. And there are plenty of other ways to make money in this world. And so for me, long-term investing is a totally different psychology. There, patience is the important thing. Sitting is where you make your most money. Imagine you bought Apple, back 20 years ago at whatever, $1 or something. And let's say you saw it go to $3 and you said, oh my gosh, look how smart I am. I tripled my money. Well, if you sold it at $3, guess what? Apple's now what, $220, $230, $240? You missed the long-term gain. Now, I'm not saying you can't take a little off the table, and you should over time, but the patience of it to sit with a long-term holding is the way you make money over the long term.
Yeah.
That's the patience part.
Do you get intrigued by seeing what the market's doing, seeing if there are any more sort of Apple type companies emerging? Is that part of the fun for you, or do you really just focus on what are the core stocks that have performed over the last 20, 30 years that are consistently doing it? Do you ever look for those little acorns that you think, actually, that could be another Apple?
I think part of the fun of being in this business is always trying to find those acorns. And I believe even with my most conservative investors, most of them want me to take a little bit of their money, not the whole thing, but a little bit with some of those acorns. And so I do enjoy that part of it. There's an expression that I was told long ago where you hire a kid. And the expression is that once you get to be an older investor, all you're doing is buying those conservative core kind of companies. And it's those kids that want all the excitement. But what I would tell you now that I've gotten older, it's fun no matter what age to try to find those acorns. And that's the other point of taking a little off the table. You may have a fantastic stock and you read the headlines and you think there's no chance this company can ever go down. And yet I would tell you occasionally, if it becomes too big of a part of your portfolio, it behooves you to take a little bit out of it. And that's what you can use to buy some of those acorns with.
Fascinating. I was thinking around, as you were talking, I'm thinking that the word that's come into my head is gratification. So do you have to, I guess in those early years, did you have to be mindful of your own, that immediate gratification to get a return quite quickly? And also, is that something that where you have to manage your client?
Definitely. All those emotions come into effect. And I think early in my career, sometimes it was the humility part of it. What I found is so often when I started counting the dollars that I was making in a company, invariably, and I don't know if the universe was listening to my thoughts, probably not, but it seemed like invariably that stock would drop. And there goes the money. And it's as if, the market teaches you that there is that volatility and randomness in there, and you really need to manage your emotions. And part of that is gratification of feeling kind of trying to be more in the middle of things. I guess I think of my grandpa that way. He was a great golfer, and he always talked about, the golf swing is like life. It's a pendulum. And it's moving back and forth, and that thought of both being grateful and also being humble is, I think, key to that success, because there's surprises around every corner. And just when you think you know what's going on, something else is going to happen.
Yeah.
And now, of course, there's always going to be someone out there saying, I knew it was going to happen. But generally, that means they were saying it for 5 years. And most of us, though, should be prepared for the surprise, and that's part of managing your expectations,
Yeah.
is realizing that, you may be at a certain age and people say, oh, you ought to have 80 or 90% of your money in stocks or something aggressive. But if your risk tolerance isn't there, it's going to hurt you over time. And so you've got to manage that your own unique personal risk tolerance.
It's fascinating around, I said it, I think even before we started recording, that blend of finance, psychology, and how we understand money. And obviously, I'm going to get into your approach in a second, but I love the way that you're taking the stress, because I think money for a lot of us is stressful because we haven't had this type of education, and also if we're raised in a family where historically money has always been quite stressful, we haven't worked in the financial markets, and we don't particularly understand it, then it's almost counterintuitive to kind of think, actually, money doesn't have to be stressful. We think, what, really? No, it doesn't. So that's why it's really interesting. Something I read in your book, I read the first chapter, and I think, is it Dr. Price?
Yeah. Yes.
Dr. Price. So that was a very interesting client that you had, where you, I think you had him who was, he felt to me that he was probably less patient about long-term investment. But then you had, is it Jane and Alan, who were the opposite, who actually understood, they developed some of the tools that I guess we're going to talk about in a second.
Yes, and I think that the title of that chapter might have been the man who did everything right and the man who did everything wrong. And of course, it felt poetic, but actually it was a couple. It was Jane and Alan who did everything right, and of course Dr. Price, who reminded me of, there's a great Seinfeld episode called The Opposite, where George discovers, he makes the comment, everything I've ever done, every decision, every action has been wrong. And he says, now I'm going to do the opposite. Well, Dr. Price, in a short period of time, was the opposite guy. Everything he did was emotional and wrong. And if we distinguish those two, and it was the same event that kind of captured both of them. Dr. Price came to us. He had, unfortunately, he had retired, had taken his money to an investment firm that was 100% one thing or 100% the other thing. And they decided to put 100% of his money in long bonds. Now, without going into the whole concept of bonds, long bonds can actually be pretty risky, because if interest rates rise and inflation rises with that, and you have a 30-year bond, that you could lose a lot of money with those bonds. And he did. And so he fired that company without, after 4 or 5 months, he didn't understand the risk he was taking. He fires them again without learning the lesson of what can happen when you own one thing. And then he hires us. Well, we talked about balance. You ought to have a little bit of this, a little bit of that. So we sold some of his long bonds, bought a little bit in stocks, and he was maybe a third. And then, of course, unfortunately, the 1987 crash happened. That's an event where the market dropped 22% in one day.
Wow.
Imagine, people get excited today if the market drops 3 or 4%. Oh my gosh, the headlines are screaming and everything. Imagine a quarter of the market almost coming off the table. Well, he was hysterical. He fires us and he says, I'm never buying another stock again. I'm going in and I'm just going to roll CDs. Well, of course, that was the bottom of a market that, would go up for the next 15 years.
And what a CD, sorry?
Sorry. CDs are like short-term bonds or money market funds or savings accounts, almost like he went really aggressive in bonds, balanced in stocks, and now he was going to just basically own a savings account type of investment. all at the wrong time. Strike one, strike two, strike three. He was emotional. He didn't understand what he owned. But contrast that with Jane and Alan. Now, same event, but Jane and Alan had come to us, and this was early in my career, but I was fortunate enough to talk with them, and they actually worried about a stock market crash. Now, in hindsight, I always joke, I wish I had listened to them. They seemingly knew it was coming, but what I told them is, let's assume a crash happened. What would happen to your portfolio? What would it decline to if it dropped 22% in a day? And we looked at that, and they didn't own a lot of stocks, and they said, we'd be okay with that. We still have enough income. We still have enough for our retirement, and we'd be okay. And if that's what you think we should have, then, when that happens, we could even buy more stocks. Well, 3 weeks later, the stock market crashes. And I call them up feeling terrible. And they said, well, Mick, you showed us what could happen. I guess it's time for us to buy stocks. And so by taking in the downside, by looking at what could happen, the same day that Dr. Price was selling everything and going into savings account, making the exact wrong choice, Jane and Alan were buying the stocks right at the bottom. And I worked with them almost to the end of their lives, and they were constantly mellow, constantly easy-going, always kept to their long-term objective. And at the end of their lives, they had about the same amount of money as they started with, because they first lived within their means, but also assumed that there is volatility in the market and they could handle it.
Yeah, that's really interesting as well, because that idea of calmness when the markets are tumbling and everybody's going crazy, they had that presence of mind, tutored by you guys to have perspective, but also realize that there was an opportunity to actually look at some stocks, get them at an amazing rate, and obviously when things stabilize, that they're making money, or they've made money.
That's right. And the key is that expression of strong hands. When you're not panicking, you can make those decisions while the headlines are terrible. And believe me, I've never seen a market bottom where the headlines said, oh, don't worry, it's just the stock market.
Yeah.
The headlines are always awful at the bottom. And so you have to have that calmness of, this too shall pass. It's happened before. The good markets will come again too.
How do you balance out? We'll talk about your approach literally after this question, but I was keen to get your thoughts on the media. So when people will go on to, everyone within their own country will have their own television network stations that will talk about the markets, Bloomberg and CNN, or different channels, BBC over here. Sometimes they maybe panic people, particularly if we don't understand it, like me and others who will hear a headline and actually we feed totally into that. So our emotions are focused on, there's going to be a recession, there's a downturn, we've got to, just really do nothing, just don't spend any money, don't do anything. We're in panic. We're not thinking, actually, let's have a bit of perspective about what's going on. What's your thoughts around the media and on occasions how they can maybe spook people like me?
Well, at the risk of never being asked to be interviewed by the media, I'll say that they do not do anybody a service. And I'll leave it at the investment side of things. But I would encourage people to listen to, podcasts like yourselves and others, where you're learning about things over the long term. But listening to somebody, they've been talking about this imaginary recession for 2 years, the economists. Well, there are two things about that. First of all, if you say something long enough, eventually they'll be right. But then secondly, the recession doesn't even mean that the stock market will come down. And whether the stock market comes down or not, that may or may not affect your unique objectives. You may be like like Jane and Alan. And that might be a good thing. You might be a young person who's averaging into the market every month, putting money in their retirement accounts. A down market is a good thing. Each month, then they'll be putting money in at lower prices. And so to get scared because somebody is saying, oh my gosh, the market's going down. And the other thing I would say is it happened early in my career. I was sent to get some data out of newspapers all the way back to the 20s and 30s, moving forward. And I couldn't help but look at all the headlines each week as I was getting this data. Every other week, the world was coming to an end. And of course, you had, World War II, you had Pearl Harbor, you had the Great Depression, you had the Kennedy assassination, you had, and of course, you had little events along the way that I can't even recount, just like we're seeing today. It's the end of this, it's this, or, what happens if this happens? And the hand wrenching that's going on does not help your investing at all.
Yeah.
Set your long-term objectives. And I have to understand what's being talked about. And so I tend to read a lot, because listening to the people one after another, I don't think is helpful, even if you're a professional. That's my own opinion.
Yeah. No, I definitely, not having your expertise, but I definitely sense and feel that doom mongering is there. And I think we all see that. And sometimes it can be, you almost think that we're sleepwalking, we're creating these scenarios, we're accelerating these things because of the negative language that we use. And it's interesting to speak to somebody like you, an expert on this, just to get a perspective, because it's something that I feel, without having that level of expertise to kind of, to be 100% around that. So your approach, the Mellow approach, and your book, Mellow Money, tell me about that, how that sort of morphed into existence, and why you wanted to sort of support clients and people like me and others that maybe money is historically, maybe it's been a bit more stressful and it has more stress in our lives.
Sure. And so I started, I guess it was during the pandemic that I was reflecting back at many of the lessons I learned, both personally and in the markets, and realized that these are, it's a way of summing up the way I manage money and the way I try to live. And it's through stories. And most of the writings, not all of them, but many of the writings about investments are very academic. They're textbook-ish. They're not, in my opinion, not readable. I've never been a textbook kind of person. The lessons I've learned have been through my experiences. And so I both wanted to kind of hopefully translate my experiences into lessons that people could learn from, but also pass on the education that it is through our experiences. Even if you say, read my book and say it's helpful, I guarantee you, well, you shouldn't ever use the word guarantee you, but in the markets, but we'll all make mistakes. I continually make mistakes and I continually learn from them. Hopefully you move on and there's other lessons ahead of you, but occasionally you get a review lesson. And so if you look at your life that way, that's important. And then it's part of the experience in the markets is that unpredictability, but that things tend to work out over time. And I do have a client that he unfortunately had a investment advisor back in the late 1990s where he got put in a bunch of technology stocks, and of course they crashed. He still had some funds left, and he moved to another advisor who owned some financial stocks. They did poorly, of course, in 2008. And then he comes to me, and for the first handful of years, he was very skeptical. But he realized over time that this balance, having a balance of different things, not trying too hard, being patient with good long-term companies, eventually works out. And he'll still call me up when something is going wrong. What if this happens? What if, different results in the election? Or what if the government shuts down? What if there's a recession or any of the things that are out there? He'll call me up and he'll say, Mick, I know what you're going to say, but I need to hear it one more time. Yeah. And so, it's having that patience. And for him, it's, I'm that sounding board that kind of, is telling him things are going to be okay over the long term. Might be a struggle. It doesn't mean that we don't do this or that on the margin, but really it's in the end, if you Google how to invest, you're going to get in the internet 5 or 7 things or 8 things. And most of those rules are good rules. Thing is understanding the psychology of sticking to them.
Yeah.
If you have an objective, if you look at your risk tolerance and you say, I can afford to have 60% of my money in stocks, as an example, and the market goes up a lot, well, guess what? That 60% is going to turn into 70%. Well, at that point, you should be more like a mechanic. Take it back to 60%, which means you're selling stocks as they're rising. Same thing if they fall. If they fall, at some point you say, now they're low enough, I could take it back to 60%. And so it eases the emotions because you're having this long-term view of the world that it's going to work out. But that doesn't mean I don't take a little money off the table when things are good. I add back in when things are negative. If you have that philosophy and that strength, then over the long term, I've seen people make fantastic amounts of money just by being patient.
I love the analogy you just gave around if you've got, say, 60% and you see a change in the market. I think you said there's an upturn, you've got 70%, you can reduce it. I love that. I love the mechanics of that because I think from a layperson, I think there's huge education there around those little tweaks that we can make to understand the markets, but also improve our situation, improve our position.
And yes, and the other thing I would say though, that typically at that 70%, the headlines are more positive. The times are good, and so you're actually not being encouraged in the press.
Yeah, of course.
To usually do the things that you ought to be doing. And so when the headlines are the economy is good, inflation is low, good time for stocks. Look at that. Look at your percentages and don't pay attention to those headlines necessarily. Same thing on the decline. When the markets are down, like I said, I've rarely seen good headlines. It's always, oh my gosh, interest rates are up, the recession is coming. There's something else around the corner.
And interestingly, I can't remember where I read this somewhere, but there's definitely parallels here that in difficult moments, we're talking about, I don't want to say recession again because I probably said it too much, but in those difficult moments, recessions, people do well, companies do well, people do well. And we think about recessions as it's exclusively doom and gloom. But there are people with the type of education that you're providing, they're able to understand actually there are opportunities here, but it's just there is a different mindset that we have to, because if we focus on the negative, that's all we're going to lean into. We're not thinking actually maybe there's something here there's some opportunities here.
Exactly. And can you imagine if, people always say, I wish I knew the headlines at the end of the year, I wish I knew, a year ahead headlines and look at what I do. Think back to the pandemic in 2020. Let's assume that you had a crystal ball and you knew there was going to be a worldwide pandemic, shut down throughout economies throughout the world. The market was going to drop hugely in a month. And if you knew those headlines, you'd say, I'm out. No stocks. I'm not touching things for the year. I'll come back in, a year or two. Well, yes, March, when things really shut down, the market broke down really sharply. But if you look at the end of the year, the market, as determined by the S&P 500, was up 15%. Now, who would have thought in a year where it's about as bad as you get, the stock market somehow managed to gain 15%. And that gets back to, we really don't know. We don't even know if we knew the news, what the risk on the market is. So that gets back to why you should be a mechanic, because, life is unpredictable.
Yeah. I remember speaking to a friend of mine who I used to work with, and we would just catch up. We probably catch up maybe once a year, and it was that time to catch up. And he was telling me that during the pandemic, he kind of educated himself, started reading different content around finances and around financial stocks, bonds, that type of thing. And he actually said, I made probably more money than I earn just by understanding stocks and buying stocks at where they had gone down they'd gone down a year later, they'd gone up. And he said, I made probably more money, or nearly the money that he would have made slaving away for 45 hours a week.
It was interesting, and it was interesting to see different companies. Of course, some of the usual suspects, of course, did really well, but that's the way the market works. And you could, of course, if you're really into it, you're going to own different stocks and such. But even if you own just the index funds, you just own this diversification of stocks that's the S&P 500 or some other basket of companies, you did just fine, during the pandemic and beyond. And of course, a couple of years ago, there was a decline in the market. And that's when people started talking about this recession that was going to be coming. But in the face of all that bad news and the market going down, now we've had 2 great years in the market. And so I try not to predict too much. Everybody always wants to know what you think going forward, but I've not found that to be as helpful as sticking to your objectives.
Yeah. And I guess ultimately, I think you already said that mistakes happen. We're going to make mistakes. The opportunity is, it's like this podcast, My Perfect Failure, it's learning. It's actually, there's always an opportunity when something hasn't gone the way that maybe we predicted or we wanted. There's another opportunity to understand that, okay, maybe we can factor that in if a similar type of scenario, comes up again.
Absolutely. And I think whether it's our failures or mistakes, and of course, there were things in the stock market that have taught me about my life, and things that happened in my life that really helped me become a better investor. And so that's where I think things are really interrelated.
Yeah, that's beautiful, that when you can see that clarity and you can connect them, because I think sometimes it can be very difficult. I've mentioned that without being educated around this, then there is a disconnect. So the book, who's it aimed for? So would you like, I was, as you were talking earlier, I was thinking this probably would be a good book for like people starting college, going to college, where we can start, maybe even younger, I don't know, but just really where we have that foundational improved, I guess, you talk about human behavior and psychology, philosophy, all those things in relation to money are improved.
Yeah, I'm by nature not a salesperson, but the way I wrote the book was really for almost all potential people. Of course, the young person who's never had an investment before, I think it's a great experience, great, kind of introduction in a friendly way through stories, and they're my stories, but they're very readable. And so I think it's an easy read for people getting into things if you're a younger investor or just starting out. But on the other hand, if you're an investor who just wants a different perspective, maybe you've been watching these financial shows, all your life and been struggling with, how do I put those into my life, and are they important or not? I think they can help the older investor too. And I've sometimes thought that advisors who are helping other people sometimes get stuck in, well, I'm told to tell people this, and this is what I should tell people. And sometimes I'm hoping that the stories I tell give perspective, even in counseling other people.
Yeah.
That we should be a little less, I don't know, salesy, or a little less just putting people in boxes, and really pay attention to what their psychology is and what their long-term objectives are, and not just be so robotic, I guess is the word, about how we approach it.
Yeah, now your approach and talking to you, it feels very human-centric. It's leaning into the whole sort of ecosystem of money plus us as human beings, and acknowledging that there is we can have a healthy relationship with money where it doesn't have to be stressful. Because I don't know this to be a rule, but I think there might be some investment advisors that maybe they just haven't been tutored in this way. It's very kind of it's very factual. It's very this is your money. They don't really bring that human psychology element to it. It's not because they're bad people at all. They're good people, but it's just that they haven't been tutored themselves in that way. And I think from non-experts and there are a lot of us out there, I think that if we can remove that kind of the stress that sometimes money can have, and also inform us that actually, there's an opportunity to learn and enjoy your money. That's kind of like who doesn't want to go there?
That's what I'm hoping, and I think that by having that perspective, whether it be on our money or our lives, that relaxation makes us just happier people, and that alone can make us more successful. I always think in business, you end up usually working with people that you like. And
Yeah.
if you can approach your life in a way that isn't so stressful or overbearing, you become a more likable person. You become a person that's able to give more and put out in the world more. And that's who people want to work with and deal with. So that's again where it feels all interrelated.
Yeah. I wrote down something here that I think you wrote. Money management can be a form of meditation.
And where I say that is because when you think about it, if you sit to meditate, and when I first learned to meditate, it was all about trying to quiet my head, and I was a complete failure at that. The idea of just wiping out the thoughts in your head seemed impossible. And then I came upon a teacher who said, "No, it's not about quieting your thoughts. It's about being mindful of your thoughts." And that I could do. In other words, quieting sounds like you're trying to do something. And what meditation is actually being mindful of what's going on in your mind. And it's a funny thing that I won't say it's 100% true, but if you sit for 15 minutes, and even if there's something you're struggling with in your life, and that thought is just dwelling on it, it's coming through. If you don't try to shut it down, and you just allow that thought to come, and then gently try to push yourself back to your breath or whatever it is, eventually you'll find yourself thinking about something else. Another thought comes through your brain, and then you realize, oh, these are just thoughts. I'm not my thought, and my thought, sometimes they're good thoughts and sometimes they're bad thoughts. But that practice that I learned really helped me relax. So zoom forward to your question, how is money management like that? Well, just think of the crazy markets every day, and the ability to panic over this or worry about that and everything else. But if we become mindful that the market is just a collection of companies that occasionally will be volatile one way or the other, and we have an opportunity each day to take advantage of that or sit and do nothing, that too is a meditation. That too is bringing that mindfulness to our lives. And that can happen in the markets, which is, of course, the subject I'm more familiar with, but it can happen in all areas of our lives if we become more mindful of them.
Yeah, absolutely. That's definitely a skill and a practice. And to labor on a good point, it will remove stress as well. And actually,
Absolutely.
And I would imagine make us more considered and on point when we're thinking about what's going on. Because when we're stressed, we're not, we're all over the place in terms of our decision making and our thought process.
Absolutely. And I think by taking some minutes to sit and just let those thoughts come through, I found it can spark your creativity, and also lessen those negative thoughts throughout the day. And so it's again, I'm sure there's people who will meditate and conjure up, they're up on the mountaintop in a crystal mountain. For me, it's just sitting and being mindful.
Yeah, absolutely. I was thinking as well, Mellow Your Money, for people that may be watching this now, that maybe want to start investments, whether they're young or old, this could be a start. This could be a lovely book to read to sort of set as a foundational piece to get them going.
I think so. I think that you would probably blend that with working eventually with an advisor, or working
Yeah.
and slowly putting money in. I think some people accidentally are doing the right thing when they're putting their money in a 401k program.
Mm.
They're forced, or not forced, but they are allowing themselves to invest slowly over a long period of time. And so I think there's enough lessons in that book to kind of get people started. I have a client, he had, I think, 15 grandchildren. And he always told every one of them when they got to a certain age, make sure when you start to work, pay yourself first.
Mm.
Of course, you've got to pay your rent, or pay your mortgage, or pay the electric bills. But if you wait till the end of the month to say, oh, then maybe I'll have a little left to put in the market, it's not going to happen. So it should be part of that upfront expense to put a little bit of money away each month. And over time, I've seen people, again, by just being patient and going one foot in front of the other, make a tremendous amount of money over the long term.
Yeah, definitely. I definitely encouraging everybody to get your book, Mellow Your Money. I love the title, by the way. So something actually I wanted to, so something, so I wrote something down. It's kind of like the same thing, but it's around just having stress-free money. And I think that's a great statement, because I think people, particularly in the UK, I'm sure it's the same in the States, people are stressing about prices for food, this, that, and the other. And I think it's good to think about money differently. So I definitely can ask you for, I think I've got a link. So I'm going to put a link to your book on the show notes. And if people want to, I guess it's available in all the logical places, would it be?
Yes, Amazon, Barnes and Noble, and available in all formats. If you're not sick of hearing my voice, it's an audio book,
Oh, really?
and of course, it's a book you could read too.
You've been busy.
It was a lot of fun. That was another thing. The idea of me speaking in a studio was a fascinating experience. And but I thought, I don't know if I'll ever have another book, but I wanted the whole gambit of experience there.
And that's brilliant. Do you think that there could be I don't know, a follow up to this book?
I don't know if I would have a follow up on the investing part. I thought the whole mellow concept might work. You could have, mellow your dating, or mellow your politics.
Yeah.
Not to say, this is probably the wrong time to be saying that.
To be honest, I actually think that would do really well at the moment. I think there's a lot of people that need that one, but there you go.
No question. So anyway, I thought that maybe I'll, if I have some time, I'll play with some of those concepts. But I think in so many areas of our life, we can try to look back and laugh a little bit, and realize that we don't have to take everything so seriously. I know that there are struggles out there, and there are real problems people have, but oftentimes, if we reflect that this too shall pass, that great expression, that it can lighten up our life a little bit.
Yeah. What I was going to ask you, actually, so Warren Buffett, are you a fan of Warren Buffett?
His investment style is a little different, but if you look at most of his quotes, they're long-term oriented. They are for the average person, and I think he's done a lot to help people over the long term.
Yeah.
And if all you did was invest in Warren in Berkshire Hathaway, you did pretty well over time. So I think we all have different styles, but I think he's done a great. He's been a great asset to the community, and the lessons that he passes on are very, very valuable to people.
Yeah. And I'm sure that if somebody passed him a copy of this book, I think he'd read it and I think he would think, okay, there's some things here that, because I think the thing about Warren and people that of that sort of ilk, I think they always want to learn. So they always want to read things. Like you said, you like to read things. I think they always want to read things because I think people that are wise, this is a quote. I won't be able to say it verbatim, but I think a wise person, I think when we realize we're wise, or we have wisdom, sorry, when we realize we have wisdom is when we realize we don't know everything.
That is so true. And I think, what wasn't it, Socrates who said it long ago? But I do believe Warren Buffett is like that. I should send him a copy.
You should do. Honestly,
But
you should actually do that. He would, he would
that's a
read
great
it.
idea. I'm doing it. I'm
You
doing
should
it.
do that. He would read it. He would read it in his office with a can of Coke.
And
He
not
would
and
take
not
it.
new Coke. It's the real Coke.
Yeah, exactly. Maybe I should. Yeah, exactly. He would, because I would 100%. I'm glad that you would do that. If you do that, that'd be amazing. You might send him and actually sign a copy as well. Definitely sign it.
Absolutely. And when he writes me a note back, I'm going to send a copy of it to you with a thank you.
That'd be brilliant. That'd be brilliant. And so I've signed up to your newsletter. So you've got a newsletter. So I guess that's there for people to sign up to as well. People want to become familiar with more of your content.
Yeah, mostly I think the sign up, it kind of gets the articles I write, which are not consistent, but occasionally, and links to programs such as yourself too,
Yeah. Okay. Okay. Perfect. Okay. Mick, wow, it's been amazing. I do have one last question, actually. So the recurring question on the podcast is, if you could invite three inspirational people for dinner, and they can be alive or past, who would you invite for dinner?
So three different people from different aspects. I would say number one would be Benjamin Franklin. He was of course, he was a great patriot, great inventor, but he also was amazing at self-reflection. He said he scored himself each day on like 13 different things. How did he do? And always wanted to improve. And I think one time he told a friend, I scored perfect in every category, in all 13. And of course, then he looks at the friend, I think, and he says, maybe I should add humility to the list. It's just that feeling of always wanting to learn. You just talked about it. I love that. I would love to learn about, his experience. He seemed like quite a character too.
Yeah.
The second one, I don't know. I'm fascinated with Eastern religion. I would love to meet the Buddha.
Okay.
And see, how he, what his thoughts are on mellowing your perspective. I think he had a great perspective on being mindful. It's kind of back to that thing of always looking at your life and having moderation in everything. And so I think that would be a fascinating conversation. And then if I go zoom forward to the investment world, there was a great trader back about 100 years ago named Jesse Livermore. He actually wrote a fantastic book that I would recommend called Reminiscences of a Stock Operator. And it was all about the lessons he learned in trading back in the early 1900s. And if my book even approached the wisdom that he passed on, I would feel, honored. But if you ever look at great investment quotes, just Google that. It's peppered with quotes by Jesse Livermore. By the way, the pen name for the book the author is Edwin Lefevre. So that's the name he printed it under, but it's Jesse Livermore who wrote the book. Anyway, those are the three dinner companions that I would love to join me.
I think that would be a good dinner.
It'd be fascinating.
That'd be a good dinner. There is one last question, actually, kind of covered it a little bit. But if people want to find out more about you, where's the best place for people maybe to reach out to you and try and contact you?
Sure. My website is mellowyourmoney.com. And if you wanted to contact me directly, it's Mick at mellowyourmoney.com. And I would love to talk or correspond with anybody.
Okay. Mick, Wow, love this conversation. Wonderful what you're doing. I really love the fact that you're giving people really just a different slant around finances and money and how they can have a different relationship and also the learning as well. I think the education piece is there as well. So yeah, fantastic. Really enjoyed talking to you today.
Thank you, Paul. I think you do a great service for people, just bringing out all different lessons and ways to benefit from your failures. I think it's fantastic. I really appreciate it.
No, thank you. Thank you very much. Hopefully we can have more conversations in the future.
That would be great.
Thank you. Thank you. Thank you, everybody, for tuning in to this episode of My Perfect Failure. If you're watching on YouTube, please do hit the subscribe button. We're always keen to grow the channel, and your feedback is most welcome. So we're keen to hear about the things you like and equally the things you don't like. So you can find me at paul@myperfectfailure.com, or you can find me via the feedback page on the website. So take care for now. Bye.
Thanks for listening to My Perfect Failure podcast. Be sure to visit www.myperfectfailure.com to join the conversation. Subscribe to our podcast on iTunes or Google Play. Look out for our next episode.